mainly from a long period of easy monetary policy and the workings of the innards of the economy, and to some extent from the tax cuts and increased federal government purchases that came out of the fiscal side of what we call Trumponomics, fiscal stimulus. That stimulus, by the way, on Joint Committee of Taxation numbers in 2019 will be double the size it was in 2018. So that fiscal stimulus is going to be stronger in 2018 than it was in 2017, with the behavioral effects from 2018 lingering into 2019. That is a major reason, a taking over of the reins of growth from the fiscal stimulus side in 2019 as monetary policy gets less accommodative. The policy mix, fiscal stimulus, less easy monetary policy but still accommodative, is part of why our forecast has the U.S. economy growing at 3%. We would put the odds very, very low of a recession in the United States over this next 12 months, no more than 5%. No more than 5%. Now, it's interesting to have that view and to be here in the middle of a big stock market correction in the U.S. and other stock markets of the world, which in 2018 produced negative years in the major stock markets in almost all countries. But you know, it's not so odd to see this big difference between Main Street and Wall Street. Wall Street does well when Main Street isn't doing well. Wall Street does well because when the U.S. economy moves from unemployment rate of 10% down to 3.9, in that process is more growth, more earnings, low interest rates to keep it going, and that's what drives stock prices, earnings and interest rates on fundamental valuation. Ahead of that time, the stock market does well. So Wall Street is the first to benefit. Real estate is the first to benefit from stimulative economies, easy money that gets an economy lifting up. When Main Street finally delivers the goods that Wall Street has predicted, like any time in the stock market, the news has been discounted. You sell the reality, you buy the story. And what now looks to be the case in the U.S. for 2019, inflation in the 1.75% range, below the target of the Federal Reserve of 2%. That's a half a point lower than we said 6 months ago. It's definitely a shift down in the rate of inflation, and in other countries as well. The rate of inflation in Korea is very low. It's running about 1.5%. It's very low in China. It's still very low in Japan. It's still very low in Europe. It's low everywhere. There's something going on out there that makes inflation low no matter how economies do. That low inflation has already made our Federal Reserve back away and talk much more dovishly, much more tenderly about how many times they'll raise interest rates this year. We are now talking about one hike by the Federal Reserve in June, maybe none, at most two. In their latest meeting and plan, they said two. But still, we will get a nice gain in corporate profits, corporate earnings, and that to us, and the expansion, and the relatively low interest rates are what will produce a U.S. stock market that could go up something like 7 or 8% after last year's big decline. And I might add other stock markets around the world should do well too. Our functioning in Washington is a poor imitation of how a government should function. And Americans know this. They know it. They can't do anything about it. In part, they elected President Trump to fix it. And he did what he's always done, if you read The Art of the Deal and watch his career, what he's always done. He gets to the top, and then he doesn't know how to run the business. And if the people around him don't run the business the way he wants it, he gets rid of them. And I do think America will get rid of him, because if he were on my board and I was a board colleague, I would never have him on my board. You can't work with him. It's his way or no way. And if he ran my company and I was on the board, I'd fire him in a second because he destroyed the stock of the company for his own personal aggrandizement and ego gratification. Am I going to put my money in the dollar with that? Cautious investor with my capital. Will I put it in the yuan, the Chinese currency? Well, they're having trouble. They're going down. In the yen, absolutely. In treasury securities for now, absolutely. Even in gold. And there is an edge off the allocation of funds across stock markets because of this uncertainty that I'm describing in a somewhat, sounds biased, but I think I understand what we got there. But growth in Japan may be 0.8%. We're forecasting 1.25% this year. Low interest rates, low inflation, but there is a sales tax increase coming. The consumer lags in Japan. For Korea, I think the figure here I tossed out, I believe, was about 3%. I was expecting a good year, reasonably low inflation here, low interest rates, stable to somewhat declining yuan, I probably said. And it looks like about 2.6% and 2.5% to 3% coming. That is tolerable. That's 4 years of nice growth for South Korea. This is not the booming economy, 5% growth it used to be, but it's a very nice trade surplus, diminishing a bit as part of GDP, low inflation, a relatively low unemployment rate, stable in the threes. Looks like a good year for South Korea, with risks as the whole world faces on the slowing economy in China and what that will do to exports of South Korea and other countries out here in Asia. As for China, the momentum of growth definitely slowing down in the second half of last year. We get a GDP number we think will be 6.5% year over year. That's still a high number, but next year 6, maybe a little lower. And then from stimulative policy, a weaker Chinese currency, and an ending to the trade negotiations, which will end up with some redressing in the U.S. favor. But the negotiations, we're assuming, will come to an end this year. And something tangible, both sides will say, was good, will help the Chinese economy do better. But that's later this year in terms of it helping Asia. A disruption, transformational, innovational technology that is this business cycle's technological change. It's huge. It's worldwide. I've never seen anything like it. We don't have enough data on it to get it into our models properly. What we have done with the little bit of data we can use is to find that technology that I've described and the companies that participate in it and the capital stock that comes from that has shifted the so-called Phillips curve down so we get a lower inflation rate for a lower rate of unemployment. That happened also in the late 90s when we had a different kind of technological change. In addition, we find higher productivity than is conventionally measured in the GDP accounts and GDP-derived accounts because of the role of technology. When enough data get in there, I believe that economists will sign on to this view. The Federal Reserve, I think, has signed on to the death of the Phillips curve.